Hi guys, good afternoon. Welcome to the webinar today. I'm just waiting for a lot of people to filter in where we've just started it. I can see the number of people jumping onto the webinar increasing sort of pretty quickly. So I'll just wait until that sort of steadies out, and then I'll begin with the presentation itself. Just before I get going, if I could just have a couple of people just raise their hands on the webinar just to make sure that everyone could hear me and that the sound quality is okay. Excellent. Thanks very much. That was a really quick response. So that's good. Thank you. Thank you so much. Really useful. I'll just give it another minute or so, and then I'll get started. Just as a bit of a framework for the webinar today, how it will work, I've got a bit of a presentation to run through. And then what we'll do at the end is we'll go into a Q&A session where any thoughts and questions can be asked, and then we'll take it on. We'll take it on from there. All in all, what the webinar today is about is a bit more into the idea about property investment in 2025 and the sort of strategies we're seeing a lot of our investors implementing, and to really just discuss into them in a bit more detail about how they're working and what they're doing, so that we can maximize the returns for our investors and make sure we're getting them into the right kind of strategies for their personal investment goals. So, quick intro to myself. So my name is Scott Dixon. I can actually see quite a lot of familiar names in the webinar already. So a number of you probably already know who I am or have spoken to my colleague Eamon, who's part of our property team also. My role here at GetGround, I'm one of the senior property investment leads at GetGround. I spend pretty much most of my day sitting in meetings with our investors, helping them with things like their strategy planning, the finance planning side of what they're doing, assisting with getting into the right kind of investment property, and then building that all together to actually then get them into the right property, into the right opportunity, and assisting them with sort of all those stages, then moving on from reserving a unit onto actually then moving to exchanging and completing on their property that they've purchased. So an intro to anyone who maybe doesn't know GetGround or hasn't spoken to us here at GetGround just yet. So really what we are here at GetGround, we are, what we like to refer to ourselves as is really an all-in-one property investment platform. The real goal behind what we're doing here is trying to build a really fair marketplace for our investors so that they can transact on property, they can make it the most tax efficient strategy and plan that they can. We can assist with the mortgaging, the financing side of actually getting a property, a full lettings and management side of our service, and then a lot of other sort of interim services within that regarding things like progressions of purchasing, assistance with mortgage progression, assistance with things like, well, really sort of further investment inside of investment pots in their own limited companies that a few of the names that I can see here probably already are aware of and actually utilize themselves already. In terms of where we sit, we're currently sitting with just shy of about £2 billion in terms of transacted UK property. We have over 30,000 active customers and a database of well over 80,000 property investors. How we really get a lot of benefit for our investors here is we have a really strong network across the property industry in the UK. We have over 1,400 different partners. This is including a good bunch of lenders, mortgage brokers, property agents, accountants, and tax specialists. Really with that idea that we can help anyone who needs some kind of assistance within property. We can give them a really good full all-round service regarding any kind of thing they're going to need to be successful within this. On sort of a separate note to that, we have a real strong sort of 50-50 split regarding UK-based and overseas-based investors. So in terms of that, we have offices in the UK, Hong Kong, Dubai, and Singapore, but we have client bases, spanning across Asia, Africa, America, South America. So a really big base of investors all across the world that we work with here at GetGround. And as you see there as well, you can check out our sort of Trustpilot pages. You can see that we're an NRLA recognized supplier. So really sort of got a good foundation now within UK property. So the agenda of today's webinar, and to really get sort of started into that, is to talk about strategy and really get into, I think, a lot of questions I've been getting recently with, what should I do? How should I do it? How do I get the most return for what I need to get out of this? So what we're going to talk about firstly is 2025, where the UK property market is, how it's doing, how it's working today, these different types of strategies, and what are our investors doing? What are they using? How are they finding it? Then alternative strategies. So actually, how do they compare to these other property investment strategies? And then actually getting started with that, how do we get that right sort of thing for you? Where do we start with that? How do we get things moving regarding either strategy sessions or actually looking to move forward on particular options within that? So in terms of UK property, okay, the key point here is that the fundamentals haven't changed. UK property, despite all the noise, every bit of everything you're ever going to hear regarding the market, and I think right now we're in a world where I've actually had a few questions about the tariffs from the US, or questions about still regarding higher interest rates on mortgaging, and very much what we see from that is that the UK market is a very, very stable industry, in the sense that it really runs more so on this element of supply versus demand than worrying too much about massive external factors. And I think we've really seen this actually from sort of, well, let's say that like 2010 onwards to now where we are today, just a consistent growth on UK property. Of course, within any asset class, you'll see peaks and you'll see troughs, but with that general trend always pointing upwards. Very much sort of aligns with that saying within property investment, that is, it's not about timing the market, but it's about time in the market. An investor who is invested, got a property, gaining a return, building up their assets, is going to be in a much better position than someone who sits and leaves money sitting in their bank account, hoping for the right time to buy. So what we're really seeing is that despite any sort of market shifts, property continues to outperform other asset classes over time. We are seeing an improvement within interest rates. They are expected to drop even further. We're seeing that steadily coming down. We're still in a position where, compared to a few years ago, they still look pretty high. But actually what we can still see on that front is actually the returns still looking very strong within particular properties and particular markets. Property still remains the only asset class with leverage to amplify returns. You can't exactly go to the bank and ask for £100,000 to invest into stocks and shares. What we can really do with property, again, is maximize our returns by utilizing debt to actually shift that leverage on our assets and get that sort of full level of growth over time. And demand for quality rental housing is rapidly increasing as supply remains low. I think where we're at right now in the UK, and we can see a real sort of general trend in terms of the demands of the market, the demands of the supplier, in the sense that things like EPC regulation potentially coming through. We've seen a real shift where it's come to ESW1 regulation on properties. And now what we're moving into is a world where the quality of an investment is fundamental. Actually getting something with a strong EPC rating, something with the ESW1 certificate, something in a market where we can target a really strong tenant demand and get a good quality of tenant behind that. And what I've personally seen from a lot of investors and speaking to them recently is this idea that rental yield per se has become slightly less important, as opposed to strong market, strong tenant position. And what we mean by that is we're getting a good yield, but we're also getting a very good quality of tenant, so we can actually mitigate and maximize our investment risk as much as possible, as opposed to the other side where we're looking for high yield, low quality tenant with a real risk of void periods, inefficiencies when it comes to getting tenants, or even sometimes positions where tenants aren't even in a position to pay rents and cause a lot of issues. So real sort of summary, I think, on where we're at right now. The UK is still trending upwards. The UK government still has been very inefficient when it comes to hitting supply deadlines, actually hitting supply targets, which again is allowing us a position where we're seeing the market continuing to increase. So moving on to this, and moving on to, I think sort of the first step here is a bit of a snapshot regarding investment strategies and what sort of strategies we can look at. What we've really looked at and really tried to pin it down to is 5 real would say, is core strategies that people look at. Now, there's always a slight amount of overlap that can come from these different strategies. And again, if we ever need to sit down and discuss real sort of specific cases with anyone individually, at the end of this, there'll be the opportunity to book in for a meeting. Anyone who's most likely on the meeting today will have an account manager to contact as well. And again, we can get that sorted and get that booked in to discuss that in a lot more detail. So moving on to these sort of snapshots here, we can see the top one on there, buy to let. So what we're talking about there is your very much bread and butter investment within property. Buying a property, good condition, getting it rented out, getting it tenanted. Returns that we can look at in terms of yielding, more sort of 5 to 7% in terms of a gross steady return. We like to look at this in a sense of effort versus risk, so we can get a really good feel for actually how effective is a strategy. So buy to let, very low effort. We actually, a lot of our overseas investors will do a standard buy to let. They don't have to worry about anything. It could be fully managed, no real concerns, no real sort of time spent from the investor. Main risk, regulation and rate changes. So regulation regarding, as I mentioned, EPC regulation changes, things like this, which can come in. These are things that are being floated around at the moment. When they do come in, that they will have an impact on the market. Rate changes, of course, when you're looking on what would say like the lower side of the yielding front, a higher rate on your mortgage is going to impact your rent quite substantially. What it's perfect for, investors seeking long-term income and growth. This is really ideal for someone who is in a position today. They're working 5 days a week. They're either based in the UK or based outside of the UK, but not necessarily in a market that they want to get into that's seeing a really good level of capital growth. So they need something relatively hands-off, but very simple. This is for the sort of person whose idea is, I've got 50 to 100K today. I want to invest into a property over 3 to 5 years. I want to pull some funds out of that property to look to reinvest and just progressively grow and develop on my portfolio. How I would refer to this sort of strategy is it's that kind of side of property where you're looking at the foundational level of growing a portfolio. If you're looking to start your portfolio, you start with this sort of property to build the foundations, build the backing of your portfolio, so you can then utilize that to buy more, what would say more higher effort, higher risk style strategies, but you've always got the coverage of your initial buy-to-lets. Secondly, HMOs. Certainly, I think a lot of people know and like the idea of HMOs because of that side of the returns, 8 to 12%. Effort high. This is an effort based on yourself, but also then based on the management aspect, hence why we have quite substantially higher management fees when it comes to HMO property. And also where it comes to licensing regulation as well, where we do see a lot of changes regarding regulation on HMO properties coming in quite consistently, which in turn, as every regulation changes, there's typically a monetary position in there where you're going to spend some money on actually trying to reach these changes to make sure your property is compliant and available to actually be let out. Perfect for what we call someone who's a yield chaser. They're wanting just sort of pure rental income, really willing to get hands-on with this, but necessarily they're not looking too much for capital growth at this stage. They're looking purely rent. And when we talk about this idea of growth, we'll touch about it a bit more later on, but really that position of getting into more volume-driven markets to get capital growth, that isn't quite what this one would be suitable for. BRR, so this is a buy, refurbish and rent style property. So what we're looking for in terms of the returns is very much what we call front-loaded. You're really looking for that release of funds, the ability to get into something that can really build a big bulk of cash to pull out pretty quickly. Main risk within that revaluation and refurb risk. We have seen it. And I've seen it quite a few times with investors where they get into a market, they think that if I get in there and I do some work, I'm definitely going to get some value or add some value to it. It's going to go up in value. They go to get their valuation done after doing the work. Actually, it doesn't stack up. They then have a lot of funds tied up into something that, well, the initial plan was to get a big chunk of cash out. They're now stuck in a position of not even being able to get that money out. However, it is something that if you do it right and you do it well, there is a really good position to get a big bulk of money out. But in terms of what I would say a big risk on this front is timelines and timeframes. You've got to make sure that you're aware of what you're doing, how you're going to do it, having the right team behind you to do this, having the right building team behind this to do any works that maybe do need to be done, particularly when we're talking more on a large scale refurb. And of course, within that, checking things like timelines with councils to get planning permissions that again can take a pretty long period of time. But very much for growth focused investors. And these are people with time that they can do the work, and in most cases have the skills to be able to do the work themselves to mitigate that element of having to spend too much on the works being done. Short-term let, that's what we call an STLT. This is really high return, 10 to 15%, effort very high. Again, with this side here, you've got to be cautious in terms of the markets you're looking at and the sorts of properties you're looking at. We're making sure that we're getting into areas that allow short-term letting. You don't exactly do a short-term let now and buy something in London with the Airbnb 90-day rule in London, and also on a regulation front. Always making sure that when we're looking at buying a property, we are checking lease agreements. We understand that we can definitely do this type of property, and it's very clearly in the lease agreement that we can rent a property out in this market, in this building, and make that work. Perfect for entrepreneurs, holiday homeowners, people that can get into some really good markets. They can see a really good demand and they really want to get that good level of rental income, along with that position of, if you're getting into some really strong city markets, that position of capital growth. Housing associations. So what we're talking about here are properties that we can get into and have someone manage it for us. We typically will get like a guaranteed return for quite a period of time. This is normally like sort of either 5, 10, 25 years. Effort base, very low. You just have to do the initial purchase of the property. One thing to be very cautious on this side is, again, when we're looking to buy something on this front, we are checking our purchasing position. We are checking that we can definitely get lending on this style of property. We have seen it on a few occasions where we can get lending. We have also seen it on a few occasions where things have come through our due diligence checklists and actually been unable to get lending because of the fixed time frame for the rental. Lenders don't look at it too favorably if it ever came to a position of reselling that property and it then having been a 10, 25-year housing association deal. So the main risks are the contract and exit restrictions. You are tying yourself into a strategy for a very long period of time, and it's very difficult to get out of it. You have to think about it in the sense of, if you're looking to sell one of these types of assets, who are you going to sell that to? Realistically, all we're going to be able to do is sell it to another investor who's going to have to take on that contract in that period and see that out. So again, it does make it pretty difficult, particularly when and if they struggled with the mortgaging side on that. But it's perfect for passive investors seeking a fixed income. If you're sitting there with a big bulk of capital and realistically, all you care about is, I need X amount of return over the next 10 years on this property. I don't care for rental. I don't care for capital growth on my asset. I just want that rental income. Great. You'd look at something like that. And then lastly, commercial. Returns 6 to 10%. Effort medium to high. Main risks, market shocks, lease voids. Again, it's this idea that it's not just a simple rental, in the sense that the market for renting a standard property, or really any sort of property on a residential side, there's a really big market. It takes up a very big portion of the property market. The commercial side does come down a little bit lower. And of course, then you're always sort of susceptible to market shocks in terms of businesses having issues, going under. Then you're stuck with an empty lot for however long the period of time is. But very much perfect for capital rich, experienced landlords, people that have done this for a long time. They understand the markets, understand the areas. Really good position to look at that. So that gives you a bit of a snapshot on these sort of strategies and what we're really talking about today. So getting into sort of buy to let, buy to let, what we call the strategy that does it all. Now, the reason that we say this is, I think when we look at the idea of investment, and we look at, how do we invest into something? How do we make an investment work? I think a lot of people get very sidetracked by the idea that property investment is all about the income. Actually, the way that investors make the most money when it comes to property is through the capital growth and getting into these markets that are growing. Now, why do we say then it's the strategy that does it all? Okay, well, we can get that level of income. We can get an income, and there are markets out there that actually on an AST are doing 7, 8%, so pretty strong yields. The biggest factor as to why people do buy to let is the freedom in terms of what you can do. What I see too many times is people getting too involved into what we say other strategies too early, thinking that they can pull funds out, they can remortgage, they can pull their money out. What then actually happens is people get stuck in a world where they can't pull the funds out. Lenders have looked at it and thought, actually, no, that's very much an investor-led scheme. We don't want to do the remortgage. And then you're stuck in a position of, do I sell or do I keep hold? But actually, I'm going to really struggle to buy more investments just through the rental income alone through these other strategies. So what it lets you actually do is what we call scale. So you can scale your portfolio more effectively. And it really is like the underpinning strategy to build a successful portfolio. One of the main things I talk about when I do a strategy session with most of our investors here is this idea of how do we grow a portfolio? We start with the foundations. We start with the simple, easier to manage style properties that we can get growth on. We can pull funds out, which allow us to buy more property. We can then buy into these other types of strategies and other types of assets over time to expand on the portfolio, but really focusing on that initial piece of getting the foundation, getting our money working, and then building it up. And certainly on that management side, it's less expensive in terms of management, and it's a lot more simple to manage than these other strategies. And then, of course, look, busting a few myths, the reality check on buy to let. So it's been discussed a lot. We talk about it a lot, but there's, of course, there's a few sort of common myths within there. One being, interest rates have ruined returns. Actually, when we look at it, long-term returns are still strong in high demand areas, and leverage still works. And we say this when it's done smartly. When I actually look at a lot of properties, and anyone who wants to discuss this in more detail with me, I'm happy to run through it. That actually buying a property in a lot of locations right now, even with say a 5.5% interest rate, in terms of the return on capital that you make on your cash invested, actually you still look to see a better return on your cash by buying with a mortgage with that level of interest rate than actually buying in cash in total. So it's a really interesting thing to look at and actually see how hard does your money work with a mortgage versus buying it in cash. But certainly, if anyone wants to discuss that in more detail, happy to run through that on a more sort of one-to-one basis. Certainly, as I said, you have the opportunity at the end to book in to talk about that. Regulation makes it impossible. So what we see there, regulation has increased, but certainly it's manageable with the right property setup and the right support. I think that really backs onto the idea of what we do here at GetGround, the real sort of all-in-one platform here to help all of our investors be successful within this, to really understand what's going on, how it's going on, how it's impacting, and what we can do to so much mitigate but make it as effective as possible within what we're doing. Whether that's setting things up in the right kind of structure, whether that's getting the right kind of management behind the property, just so we're getting behind everything. Actually, a lot of it comes from buying the right kind of property in the right location so that we have the best quality tenants, so we don't have to worry too much even about the idea of a lot of regulation happening in today's market. And then lastly, other strategies earn more. And yeah, look, you see there possibly, but when we look at return, and this is again, it's a very much, I think, a very sort of scoped view, a very narrow view in terms of, what am I making? And a lot of it comes from that position of thinking that property is just purely rental based. Certainly, there's a strategy out there that on a rental income base do make more money. But if that mitigates our position of either getting capital growth or being able to pull funds out, typically it's not going to make more money. A bit more sort of on that, when we think about growth and we think about markets, the way that we get growth in any kind of market is very much based on the volume of transactions. The more transactions we have in a market, the more growth we're going to see because the more demand there is versus the supply. When we look at these more sort of investor-led style schemes, because we kind of reduce that pool of people that would buy a property from us by, let's say, like even like 85%. The way that a lender will look at that is think, well, actually, we've lost 85% of the market here. How easy is it going to be for us to sell a property? Well, actually, if it's an investor-led scheme, we've only got investors who are going to want to buy in, buy at a below market value price. Potentially, will need to actually buy in cash because of mortgage restrictions, which then does have a really big impact on the returns we can make. And that's why buy to let is proven. It's been a really consistent way to increase wealth over hundreds of years for these consistent returns that we've seen over time. But again, any questions on this, there'll be the Q&A at the end, which please feel free to fire away questions in as we're going, and I'll get to them at the end. But also, if you want to discuss it more sort of one-to-one, more than happy to run through that with everyone individually and hopefully make that all make sense for everyone involved. So getting onto this point here, okay, comparing these sort of different types of strategies, HMOs, BRR, and Airbnb. So HMOs, what we're talking about there, higher rent, complex licensing, high turnover, heavy management requirements. And I think when we look at a lot of HMO properties, which people sometimes forget about, is, okay, we're going for a market here where we're trying to get, if we're going to get into a good market, what kind of tenant are we going to get into this HMO that we're buying? Are we going to be getting the working professional couple working in the city on strong living wages, able to pay consistent rent? Realistically, no. We're either looking for people that can't afford standard rents on a standard property, who in some cases need an element of support within what they're doing. And when we talk about longevity of our investments, getting a good quality tenant in is fundamental. And actually, when we talk about high turnover, we want to make sure that we have good quality people in who aren't going to be constantly in and out, which you do see that with HMOs, certainly shorter rental agreements behind those types of properties. BRR, great returns, when the strategy works, but it is high risk. It's very much cash intensive. It's a difficult thing to repeat. And what I mean by that is it's very rare that you'll find a great opportunity out there that has everything needed to make it a very successful BRR. And a lot of the time, people, I think, go into BRRs thinking, oh, it's fine, I'll buy something that just needs a quick bit of work on it, a bit of a repaint, a bit of a touch up, and expects that to be a really big position to make a lot of capital out of that. It doesn't really work in that way. It's really that ability to get into something that needs a substantial amount of work, having a team behind you, whether that's yourself as a builder doing it, or you have a building team behind you. But again, making sure you understand things like licensing. How do I get the right permissions? What works can I do? What then needs to be done, signed off, worked on? I see it quite a lot as well with people. They'll buy a property and even do a refurb and think, okay, well, actually the plan's to refurb and sell it. And actually they're then stuck in a position with how long does the average property on the open market take to sell? Timelines still sit at about 4 to 6 months. So we're taking 4 to 6 months to then sell that property. We're then delaying even more so that ability to get our funds back relatively quickly or start seeing a return relatively quickly. Short-term lets, attractive yields on paper, certainly, but we do have the element of seasonality, volatility, and regulations. Where you see the least volatility within the seasons is city locations, but actually where we see the most restrictions on short-term letting is also in city locations. So it's all a bit of a balancing act there to get that effective and get that right. Then we have, as we mentioned earlier, housing association. So what we get then is that fixed income, but due to the fact it's very niche, leverage is typically unavailable. And it's very difficult to actually find lending that exists to buy a property. And if it does exist, it's actually going to be very expensive in terms of the lending. You're not going to buy a housing association property, get a mortgage at the same position of getting a mortgage on a buy-to-let. And that's, again, another thing that people sometimes get a bit misconstrued is they think, oh, because I got offered a 4.7% rate on a buy-to-let, if I buy a housing association, my returns increase tenfold. Actually, no, if you can even find the lending, the actual costing behind that, the interest behind that's going to expand and increase massively as well. alongside that. And then commercial, as we said, for the experienced investor only. Market shots hit this strategy harder, and they do take a long time to recover. I'm sure we've all seen a lot of high streets and towns and areas where commercial properties lay vacant for pretty long stretches, really long stretches of time. And again, that's a real big risk on this front, is that position of actually being able to find someone to rent that from you. We're in a very small market to find tenants to rent these properties out to us. So how does it compare? How does it compare? And what we say then, you'll see on the back end, that sort of final section, final column added to this table here is the buy-to-let positioning. So actually, how does it stack up on the buy-to-let front, the actual letting side of what we're doing? So we've just spoken there a bit about the market, the growth, what we see, but actually, how does it compare on a buy-to-let side? So standard buy-to-let, on the buy-to-let positioning is very balanced, proven, it's scalable, and it's a wealth building strategy. It's very much the Lego blocks to build up what you're doing over time to build your portfolio. HMO, similar returns to buy-to-let, but with a bit more complexity and risk. And when we talk about the similar returns, we have to make sure that we're taking into consideration that 8 and 12% gross compared to them paying a pretty substantially higher amount of management, and the ongoing running cost is what brings it then down to a pretty similar level, with then an even more difficulty when it comes to pulling funds out. BRR, so the buy-to-let offers, it's a simple, low-risk position to get growth over time. It works very much the same as a buy-to-let. We just need that position to actually get into the opportunity first and be able to do the work, which is where the biggest sort of risk comes from in that side. Short-term let, unpredictable. It's very high maintenance. It's not very stable. Typically, when you look at management costs there, just for a standard management cost, you're looking at like 18%. Then with most management agents that do short-term lets, looking to charge around 15% just for things like platform costs, which then, again, your total management being around sort of 30%, it does take a pretty big hit out of that, which it still would come in if you've got a really strong or a very low void period. But if you don't, actually, then that's where you start to come a bit undone with the returns you can make. Housing association, look, it's a long-term plan there. It's very simple. It's done for you. You don't have to think about it. It's very simple. One thing I would say, I think it's meant to say not flexible, in a sense, if it's a housing association, you can't do anything with it. You lose all of your position there to do anything with that property. You're giving up the rights to that. But on the buy-to-let side, it's very simple. And then commercial. It's a buy-to-let is simple. It's liquid, but actually, again, it's that position of void periods. The longevity to get tenants in there to actually make these work is really where this struggles. So void periods really become a big factor within this. And again, more expensive when it comes to lending, because it is seen as just a purely investment asset, as opposed to a buy-to-let being more of a residential asset on your investment plan. So that's sort of my spiel there. Really keen to get a few sort of questions from people here. So I wanted to leave it sort of about 10 minutes or so to run through some questions and go through a bit of a Q&A. So what you'll see on there as well, if you do wish to book in and discuss your own personal strategies, you want to talk a bit more in terms of maybe a few things I've mentioned here today, you want to understand a bit more in detail, or even question a bit more in detail, feel free to scan the QR code on the screen there, and I will, we'll get you booked in and we can go through that together. So I'm just seeing some questions coming through now. So yeah, there's been a couple coming through. By the way, if you do ask a question and we run out of time to answer it, I'll make sure that you get a response back in time to your question. So first question I just got here is, why is it difficult? So this was more sort of targeted at the HMO point. Why is it difficult? I mentioned about getting like a remortgage on a HMO. A really key way to look at it, right, is the way that lenders look at assets They'll look at it in a sense of where's my risk. So them giving you the leverage initially, it's relatively low risk in the sense that you don't they're not expecting a huge level of growth on the asset, but they can see that it rents well, you can pay your mortgage, you can cover the costs. The reason they struggle more when it comes to the remortgaging side is due to that sort of fluctuation in the sense of you're not guaranteed a level of growth. They struggle when it comes to giving the money back. Well, the way to look at it is think about it in two ways. If you have a standard buy-to-let property, a standard house or flat, and you look to sell that, you have the full market. Anyone out there, whether they're buying their own home or buying an investment, can look at buying that property. So on their side, they're like, that's very low risk. We could sell that pretty quickly if we had to. The HMO side, again, we can only sell that to another investor, which again is going to mean lower pricing, slightly more technical when it comes to the mortgaging side. Again, a bit more risk for them. I just had a question come through there, which was I bought a, a 2-room service apartment at in Liverpool, ready by the end of this year. Is that a risk? In a sense, no. So I know that site very, very well. The site itself, as we would have gone through with you, and part of our due diligence, then checking on that is the ability for the short-term letting. That property there, we've got a really good position there for short-term letting, but also in the building itself, we have residential owners and we have residential letting going on there as well. So when we think about growth, we're still going to get that element of growth as if it's a standard apartment. We just have that benefit there that we have the lease agreement that we can do the service department. And where your property is smack bang city centre of Liverpool, right near one of the main train stations, really good access across the city. So no, on that side, works really well for the ability to pull funds out over time and make that work. Do we still insist on the one limited company per property rather than more than one property in a company? That side, really, honestly, it's very much you can do either, right? It's not a case where you have to do one or the other. We see a lot of flexibility when it comes to that position to do the one limited company per property model, because it allows people to ring fence their assets in a really successful way. It really helps to mitigate a lot of investment risk across your portfolio. But with that particular question, I'd love to sit here and say that I'm a real expert when it comes to everything to do with limited companies and everything on that side. You should have your dedicated account manager. If you don't have a dedicated account manager, let us know. We'll make sure you have one, and we'll get that question answered for you in a lot more detail. And yeah, really helped out. Assuming there was no need for a mortgage, would a buy-to-let or HMO be a better investment? So really good question, and thank you for that question, because actually it's a really, really good point. It depends. It really depends on you. What is your long-term goal within property investment right now? Are you in a position where you're in the stages of growing and developing on your portfolio, or do you already have a working portfolio today that you're just looking to add on to? If it's the first option, the difficult thing you're going to find is that if you buy the HMO in cash, you're then still stuck in a position where getting lending in the future, getting growth in the future is where you'll start to fall down on. Where the other investor buying the standard buy-to-let, whether it's cash or with a mortgage, again, is that position of growth over time to be able to pull funds out, to leverage further and develop on their portfolio. And where we get the most return on property investment is still through capital growth. So it really, on your personal situation there, and we can discuss that more personally if you'd like to. It would just depend. But if you're sort of beginning your stages, I'd say the buy-to-let side. If you're already quite established in the market, adding a HMO onto an already successful portfolio is just going to increase that cash flow for you quite nicely. Next question here. Presumably you would recommend releasing equity for reinvestment on buy-to-let. How do you deal with the stress testing when you have a larger mortgage, but relatively low rental increase? That's a really good question, actually. And I think something that a lot of people have seen in some markets, I think particularly markets like London, where we've seen, we have seen quite substantial rental increases in London, but in some markets, the pricing has massively shot up out of earshot there. So there is a bit of a balancing act there. What we typically see is a lot more, I guess, on sort of the more lower side, properties around sort of that 120 to 280,000 pound range, where the level of growth that we can get in those kind of markets, along with that where the rental is, we can see that even actually with a very minor rental increase, it stacks up quite nicely. Even in some cases with little to no rental increase, it still stacks up quite nicely because of the value we're looking at. And it's a really important thing when we talk about value and getting the right property, is being very concise with what is good value and what is cheap. What we want to try and avoid is cheap, and we want to get into good value. Because if we get good value, we're already stacking up quite nicely in terms of equity in a deal. And then we can actually see a position of being able to release those funds out over time. But yes, part of our due diligence and checks that we do does involve that real sort of stress testing behind the property. What I can do, or myself or my colleague, as I mentioned, Damon, will be able to do is sit down with you and go through an actual cash flow and show you actually how we do that, and how we can then show you over a period of time, what could you release out, how does that work, what do we then look at for the stress testing for the coverage of doing that remortgage. So yeah, please feel free to book in with us and discuss that. So next question here. Hi, thank you for the interesting talk. Just wondering about the likelihood of rent controls in some councils, saying that they are supportive if future government would allow it. E.g. Oxford has voted for that. I think look, the idea of rental controls isn't necessarily a hugely bad thing. I think one thing that we've really found in the UK is the property market has been quite severely unregulated. I think actually an element of that would be quite useful for people when they're looking to actually stress test investments, and when they're getting into things, be very realistic with figures. And I think there is always that risk sometimes of like overinflation with certain figures. At least on that sense, actually you can be a lot more straight with actually what am I going to do, what am I going to get. And I think again, like when we look at the UK market, how many things have we had over the years that have been like market breaking events or things that will cause some kind of issue with the market? When we focus on that side, that's why we can see the UK market doing very well, because of that supply versus demand. We're just not getting enough properties built in the UK. Really, on that side, rental controls is going to have more of an impact when we think of things like, I'd say, HMO, short-term lets, these types of rentals, which are more the higher yielding sides. But again, it's the sort of thing that things do change in markets. We've just got to then make sure we're ahead of the game when things start to come in place. That's why people like to use us, because we're always sort of finger on the pulse with the market. So we can be ahead of that, get ahead of it, and make sure that we're really well prepared and planned for what it's going to do and how it's going to work for us. Would I be able to transfer a property under a personal name to a company under GetGround? Yes, we can help with that. Best thing to do on that side would be drop us a message across after this. We can get you in touch with one of our consultants internally who work on our company side, and they can help you out. So yeah, please do let us know, and we'll do that. Where are your areas of interest from positioning of managing properties remotely? So it's very much in a way that we like to look at this, and this might have to be the last question. I realize we've got like a minute left. The way that we look at property and look at the market is in two ways. And we like to look at it, we call it a macro and a micro economic opportunity within a region, right? It's very easy sometimes to see the headlines out there that say, I'm going to buy in the northwest. Oh, okay, I should buy anywhere in Manchester because Manchester's doing really well. That's looking at a macroeconomic scale in that kind of market. What we want to then focus on is the microeconomic scale within there. So what can we now see happening in that kind of market? So you look at somewhere like Manchester and see, okay, the city centre, pretty expensive now. We've seen a lot of interest in, Media City, Salford Quays. What's the next region within Manchester to see? Well, if we look at the structure of that market, we can see where the money's been spent and where it's gone. So looking at that, somewhere like Trafford would be like the next market in Manchester. we look at somewhere like Liverpool. Liverpool's a really interesting one because we can see how much now is happening there. It's a real sort of cauldron for money being spent and growth really happening. And there's small markets in Liverpool that are now doing really well. You can still get into areas of the city centre. One I mentioned earlier, that's a client of ours has bought with us. And there's other markets around there as well if you're looking to go sort of even lower costing, real sort of emerging markets. How I will label any market for anyone is what we call a regressed, an established, a mid, and an emerging market. So we can see where's our what we say relatively sort of stagnant plateaued markets. Where are the established areas, Birmingham's, Manchester's that are doing well, but they've been doing well for a while. Where's emerging? Somewhere like Liverpool, or more sort of like a mid-market like Liverpool, and emerging would be places that we can see really starting to get some traction coming in. Leicester, Leeds, Sheffield, these kind of markets. But if you want to discuss some markets, and part of what I do is sit down and do sort of full area planning sessions. We can sit and talk about lots of different areas across the country, what they're doing, how they're working together, and yeah, make that all make sense. So brilliant, thank you for that. And the last one's not really a question there, but great presentation. I'll make an appointment with you. Thank you, thank you very much. No, thank you everyone for turning up. I hope that was really useful for everyone coming along today. And as mentioned, yeah, if you want to discuss more, please just book in, and I'm more than happy to answer any further questions anyone's got moving forward. So yeah, thanks very much.